Ladies and gentlemen, good day and welcome to Mahindra CIE Limited Q3 CY 2022 post-results conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Basudev Banerjee from ICICI Securities. Thank you and over to you, sir.
Thanks to Mahindra CIE management for giving us the opportunity to host the call. We have with us Mr. Ander Alvarez, CEO of Mahindra CIE, Mr. K. Jayaprakash, CFO, Mr. Vikas Sinha, Senior Vice President Strategy, Mr. Oroit Lafoin, Business Controller, and Swapnil Saudagar, DGM Strategy. So over to you, Vikas, for your initial comments, and we'll take the call ahead accordingly.
Yeah, thanks, Basudev. Good evening, everyone, and good afternoon to those who are joining from Europe. I welcome you all on this call, as also our CEO, Ander. Thank you for attending the call despite a relatively late starting time, especially for Asian investors. Sorry for the quick turnaround between results and call. We won't make this a practice. We start with an overview of the legal structure of MCIE. We would like to point out that during this quarter, CIE has bought out some of M&M's stake in MCIE, and consequently CIE's stake has gone up from 63.44% to 65.71%, while that of M&M has come down to 9.25% as against 11.43% earlier. This move again reiterates CIE management's strong belief in the growth opportunities available in the Indian market and the fact that they look towards MCIE to continue outpacing the market. Let us now move on to Q3 C22 results for MCIE, which is on page 7 of our investor presentation. Q3 C22 sales for India were at rupees 14,294 million, which represents a 34% growth compared to Q3 C21 and a 12% growth versus sequentially versus Q2 C22. Like the last few quarters, the revenue growth rates are higher than the underlying market growth rates. MCIE India EBITDA margin in Q3 C22 is 15%, despite the adverse impact of commodity prices, RM prices, as also an increase in the cost of energy in Maharashtra, where many of our plants are located. EBIT was at 11.4%, which is better than both year-on-year 10.8% and sequentially 11.1%. In India, the month of September has seen good sales across all segments, especially four-wheelers, and we largely expect this trend to continue. The festival sales are also going well. However, historically, due to the cyclicality in the tractor demand, we could see slight slowdown after the festive period in this segment. Sorry. On page 8, we have the Q3 C22 results for MCIE Europe. Sales were at 11,632 million, plus 28% versus Q3 C21 and a little lower versus Q2 C22. But we have to remember that roughly 3/4 of August is closed in Europe, so about 20 days is not there in this quarter. And of course, in this quarter, there were headwinds on RM prices and unprecedented energy cost rise, and of course, the effect of the usual August holidays that we talked about. And also, we would like to mention that in this quarter, there was a negative exchange rate translation impact of about 11%. So on a euro basis, we have grown by 39% year-on-year. The sales drop compared to Q2 C22 was 9%, which is explained by all the factors that I talked about. The EBITDA margin in MCIE Europe in Q3 C22 was 10%. This margin is lower sequentially than Q2 C22 Of course, some of it is attributable to the seasonal drop in sales explained above, and also the energy price increase. We are confident that just like the energy impact in Q1 C22, we'll be partially able to get some of these increases through our customers in the coming quarters. On the demand side, even though the customer schedules have not decreased, it is very uncertain as to what impact energy prices will have in Q4 C22 due to the Ukraine war situation. And now, if we go to page 9, we will see the consolidated Q3 C22 results, which are a combination of the India and Europe results. Q3 C22 consolidated sales were rupees 25,927 million, plus 31% versus Q3 C21, and plus 1% versus Q2 C22. This quarter represents one of the highest ever quarterly sales that we have had. And the other aspect that we would like to point out that now India is much higher than the 50% mark that we are talking about in the total consolidated sales in this quarter. Consolidated EBITDA margin in Q3 C22 was 12.8%. Consolidated EBIT margin was 9.4%, and this consolidated EBIT margin is almost close to the 9.7% that we achieved in Q3 C21 and 9.8% in Q2 C22, in spite of all that is happening in Europe. Consolidated EBT in Q3 C22 was rupees 2272 million at 8.8%, which is higher in absolute terms than the rupees 1790 million at 9% that we achieved in Q3 C21. In fact, if you see, profits in absolute terms are increasing. Q3 C22 consolidated EBT is 27% higher than the corresponding quarter last year, in spite of the margin changes. On page 11, we have the 9-month C22 results for MCIE India. Sales were 39,109 million, EBITDA 15%, EBIT 11.2%. Page 12, we have 9-month C22 MCIE Europe results. Sales were 36,871 million. Again, India is much higher than Europe. EBITDA at 10.6% and EBIT at 7.5%. Consolidated 9-month sales was rupees 75, almost 76 billion rupees. EBITDA at 12.9% and EBIT at 9.4% EBT. So we have a solid company performance despite the complicated scenario in Europe. We believe geographical diversification and an empowered management at local levels is helping us deliver these results. These two factors are some of the key features of CIE's strategic philosophy, and we'll continue to work along these lines. So with that, I'll close my remark. We wish everyone on the call a very happy Diwali and a prosperous New Year in advance. May the festival spirit uplift our industry. And let's now proceed to Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Jinesh Gandhi from Motilal Oswal Financial Services Limited. Please go ahead.
Hi. Firstly, can you talk about the impact of energy prices in Europe in this quarter and what we expect in coming quarter?
Yeah. Okay. Ander. Good afternoon, everybody. This is Ander Arenaza speaking. Okay. The energy prices during the third quarter this year were the highest energy prices we have ever seen. Okay. Even higher than the worst moment when the war in Ukraine started in end of February, beginning of March. Okay, at that time the electricity price, for example, went up to something like 300 euros per megawatt in March 2022, and in July, August we have been hitting 400 euros per megawatt. Okay, that has been the huge peak that we have been suffering in all the European countries. Okay, different in each country, but average would be like that. Okay, even in Germany we were touching 700 euros per megawatt in certain days. This situation, of course, is not sustainable, and hopefully the trend has been going down, and we have seen a cool off of the energy prices during September and October, up to this 250-300 euros per megawatt where we are now. Okay, we have been dealing with all the customers to pass through. I mean, we have reached agreements with all of them to pass through partially this impact, and that's how we are trying to manage this situation. Of course, there is a delay in the application of these agreements, so we will see a certain you saw certain impact on the Q3 margins, and we expect to recuperate at least partially in the next quarters. Okay, but that is the impact of the energy prices in Europe, in all the industry, and I would say in all economy, has been really terrible.
Okay, but can you quantify impact in 3Q for the European operations? How much margins were impacted just because of the energy cost inflation?
Okay, we have had depending on each of the technologies, we have different impacts, but generally you can consider that the energy impact in certain products where we have the heat treatments plus the heating of the forging operation, and could go up to more than 10% on this on the prices. This is the peak that we can have in certain products, but the real impact in our P&L after negotiating and after passing through can be approximately 1 to 2% on the results, on the margins.
Okay, got it. And do you also foresee a risk on continuity of operations because of availability of power or energy in fourth quarter, or that is definitely not a concern? Cost is the only concern.
Okay, in this moment we don't see that risk, or let's say that we are producing normally. We have availability of electricity and gas in all our operations. In this moment there is no signal of shortage of energy in our businesses, but it is true that there are some rumors and some comments in Europe, especially in the northern Europe. I mean, Germany or Germany, Romania, let's say all the Central Europe, where it could happen that there is a lack of gas available, so that the industry could be affected. Okay, so but in this moment we don't see that. From the order point of view, and I think from the demand point of view from our customers, we are now quite satisfied because the demand is still strong. They keep fulfilling our order book, and the order book is really strong in this moment. So let's see what's going on with the gas situation and with the negotiations with the gas suppliers, mainly from Russia or from the States, and also from the Middle East, and we are waiting for the outcome of those agreements. Okay, my view is that probably there will be a certain slowdown on the economy until the final solution is reached. But in this moment, as I mentioned, all our operations are running smoothly with no problems. But okay, the risk and the uncertainty is there.
Got it. And you talked about agreements have been reached for passing on this cost inflation. So would it be to the similar magnitude like in the recent past, where between 60 to 70% of cost inflation was passed through and balance was absorbed by us? Is the magnitude of pass-through similar this time as well?
Yes, the magnitude is similar to those you mentioned. Yes, in that range, that is the average in the market. Yeah.
Got it. And the last question before I fall back in queue is on the European demand side. So on one side, your OEM customers are indicating very strong demand, and on the other side, if I see the outlook for light vehicle production, which you have given from IHS, that talks of decline in CY22 as well as a sub 3% CAGR over the next 3-4 years. So clearly there is a dichotomy between these two. What is your sense with respect to what kind of a growth can we expect in Europe going forward? I mean, I presume the chip-related issues are largely behind us, at least from 3Q onwards. So how do you see growth going forward?
Okay. The reality is that, okay, for me it's a very complex question to answer, because the word that I used more frequently in the board that we finished some hours ago is that the uncertainty, okay, the real uncertainty that we have. On one hand, we see our customers, they are continuing pushing us to produce and to, let's say, to launch the raw material orders, because they will need the products, they will need the parts in the next months, and our order books, our EDIs are full, and the demand is really strong. On the other hand, we also see that there is the market signs that, okay, there could be an energy shortage, so that could affect the industry. So there is a risk of that could happen. So that's where we are now trying to navigate, okay, in this uncertainty. My view, my personal view, is that the automotive industry in Europe in the last 3 years has been completely depressed. I mean, especially the European, after the COVID, when we were at approximately 15 million cars in Europe in the COVID year, in 2020. The following year, due to the semiconductors, we were also at 15 million cars. In this year, 2022, because of the war, because of the energy, whatever, we are again at 15 million cars. So we are in a depressed mode in this moment. Okay, so I think we can only go up, and I expect to have a recovery, as IHS said in the last report, of 7%, 8% of growth for 2023. So my expectation is that hopefully the market will go up and will recuperate in the next years. Yes.
Got it. Thanks. I'll fall back in queue.
Thank you.
Thanks.
We have our next question from the line of Nikhil Kale from Axis Capital. Please go ahead.
Yeah, thank you for taking the question. Congratulations on a good set of numbers. Can you help us? I think in the previous quarters you had talked about constant RM growth, or revenue growth with constant RM. So can you just help us with the numbers for this quarter?
Yeah. Okay. In India, we had a raw material growth coming from the raw material with 6% approximately, and in Europe 15%. Okay, that's the figures that we had. So,
okay, so this is RM impact, or positive impact.
That's right. Those are positive impacts because of the higher raw material price year on year.
Okay. Yeah.
And that exchange impact also, Under, of 11% for Europe.
Exchange. Yes, and that's also additional
Yes.
impact.
Yes.
11% in Europe.
And we have 11% negative due to the currency in Europe. Yeah.
Okay. But yeah, very clearly you are seeing really strong outperformance versus the industry. So just if you could just provide color, I mean, which segments are you seeing, especially in Europe? Is it, I mean, what would be the revenues of Metal Castello? I think there we were running at full capacity. So maybe just some color on the PV forgings and Metal Castello, and also on the truck forgings.
Yes. Metal Castello is working at full rate in this moment. As we mentioned in the previous call, Metal Castello is doing really well, and most of our Metal Castello production goes to the US. The US market is still pushing very, very hard, and we are working 24 hours, 7 days. Okay, so, and we are adding capacity to fulfill the demand. So in that sense, yes, in Europe, one of the winners is our Metal Castello company Evolution. Regarding the passenger cars forging, yes, also the trend is also very strong, and we are selling at a very high rates in this summertime. You know that usually in summer we have the summer holidays where our customers stop about 3 weeks completely, and this year we were expecting probably a higher drop, but in fact the demand was really strong, and you can see in the figures that we were about in euros 39% above last year in Q3. Okay, so yes, the evolution is really, really strong. Part of this 39% of growth is coming from the raw material, as stated before, approximately 15%. But we can consider that passenger car is doing also really well, and the commercial vehicle sector also grew and also show certain good performance. Probably is more cyclical, and we expect a certain decline in the next quarters. We could foresee that, but overall, I think the market continues quite strong.
Okay, but just coming to the CV forgings part, I think you are seeing really strong growth, but at the same time, we've been talking about scaling down that business over a medium to longer term. So how do both these things now kind of play out in your plans?
Yeah, the point of this business, you know that the CV forgings in Europe has the less profitable business that Mahindra CIE has worldwide. This business, this poor profitability is affected also negatively in a really high inflation scenario, and also with a high raw material plus energy price increases. So the evolution of this business is more and more difficult. Okay, so that's why we rather prefer to slow down rather than growing and having additional difficulties. So our strategy there is we continue trying to improve the business and trying to get the maximum efficiency on one hand. On the other hand, of course, we have no chance than passing through the cost increases to the customers. In this business, we cannot accept 60 or 70% of pain sharing, because then we would be in a negative point. So we have no chance than being more aggressive to pass through these cost increases. Okay, so that is the reality of this business. So in the future, we will have to decide what will be the strategic route for this business.
So for the time being, can we just assume maybe growth will be in line with how the LHCV industry in Europe kind of pans out? It will continue to grow at similar levels?
Growth in Germany,
yes.
Will it be in line with CV industry growth?
No, probably what we will see in Germany will be a lower growth than the market growth. Okay, we will probably reduce certain products where we are not profitable, so we will see a certain reduction in the turnover.
Oh, got it. Thank you.
Thank you.
Thank you.
Thank you.
Reminder to participants to press star and 1 to ask a question. We have our next question from the line of Abdullah Salmani from Metaverse Equity Funds. Please go ahead.
Hi. Actually, my question is related to war only. I mean, in the aftermath of the Ukraine war and China, how will your business strategy change prior to the war and post?
How has the Ukraine war changed our business strategy?
Okay. In fact, we have not changed strongly our strategy, because CIE's strategy has been always be local to local supply. Okay, we prefer to produce in America what we sell in America, produce in Europe what we sell in Europe, and produce in Asia what we sell in Asia. Okay, that's the strategy. So we keep this strategy. Now, also because of the environmental requirements and more stringent targets that we have, we are also trying to avoid unnecessary logistic cost and emissions. So in that sense, this local to local strategy is reinforced. Considering that we are a global company and we have our let's say we are positioned in all the automotive markets around the world, I think this is the proper approach, and that's exactly what we are now perceiving from our customers. So our customers, they are now more and more looking for this strategy that I think is more sustainable and avoid logistic costs, currency exchange costs or risks, emissions, and also geopolitical tensions that time to time happen, and we know that this can disrupt and or break the supply chains around the world. Okay, so I think that's the strategy. So we will reinforce our presence in India to grow locally and to produce locally what we sell here. And also we will keep the European business and the Mexican business and the American business there in order to supply locally to all the markets. That's the strategy. There is no big changes in our view, because we had this strategy from the beginning.
Okay, got it. Thank you for taking my question.
Yeah, thanks, Abdullah.
Thank you very much.
Thank you. We have our next question from the line of Bharat Sheth from Quest Investment Advisors Private Limited. Please go ahead.
Hi, and thank you very much for the opportunity and a good set of congratulations on good set of number in the whole CIE team. And earlier we had moved one order from National Casino to India around 5 million. So how that has gone successfully, and are we seeing some of these US business orders to Metal Casino to transferring to Indian manufacturing? So what is the strategy over there?
Yeah. Yes, we have transferred part of the production from Metal Castello to India, and due to different reasons. Okay, first reason is that the final customer was located in India, so it makes sense, as I told before, the local to local approach. I think it makes sense to produce those parts in India. And secondly, also because of the lack of capacity and let's say the bottleneck that we have in Metal Castello, Italy, so that also made make pressure to us to move this production to India. So we have done this transfer. The transfer was successful, and we are producing in India with normality to the final customer. So also, it's important to say that we have had during these years we have done the technology transfer from Italy to India, and now we are producing really complex parts in India, and we have now the knowledge, we have the machinery to produce the same kind of products that we produce in Italy. We can produce them also in India. So this process is ongoing, and is ongoing successfully. So both the gears division in both regions is doing fantastically.
So in future, do we expect, to get more gear business, because the way, capacity constraint we are facing in Metal Castello to transferring into India? And if that, how big is the opportunity?
Okay. In this moment, also in India, we have, let's say, certain bottlenecks because of the capacity constraints. Not exactly in this moment, because the tractor business is now quite low, and we produce a lot of gears in India for the tractor business. But once the tractor business come up, that will come for sure, our capacities in India are also limited. So our plan is to continue investing and growing in India, and we have our plans to expand our gear division in India, and also we have plans to build new plant to continue our growth trend and take the opportunities that we have in the market in this moment. Okay, so not necessarily transferring from Metal Castello. Some of the products could be transferred from Italy to India if it makes sense. But the current market in India is giving us enough opportunities to continue our growth in India without the need of transferring production from Italy.
Okay, thank you. And second question now, ICE engine vis-a-vis EV. So Europe and India, how we are, the things are playing out. And second thing, what we have been listening that some of the people, powertrain manufacturers are reducing crankshaft capacity or transferring to other production. So, but ICE business, so how do we see gaining a market share in the ICE business over time?
Okay. In Metal Castello, as we have already explained in previous calls, we got new businesses from electric vehicles, very large business that we have now, let's say, increased. We have been nominated for additional electric vehicle products. So we see the trend clearly, and the new orders are now more and more coming from the EVs and the hybrid vehicles. So in that sense, in Metal Castello, the transition will be absolutely natural, because the market is pushing us to that kind of components. And coming back to the internal, let's say, the rest of the forging, our crankshaft business is not affected yet. We are not affected till now, because there is due to the mix product that we have with a mix of customers plus the market evolution, we don't see the reduction. But what we are now preparing ourselves is that in 4 or 5 years we will probably see a decline on the demand of these kind of products, and we will prepare ourselves to change our product portfolio to other, as we mentioned also before, from chassis component and also aluminum forgings and other kind of products that we are developing in this moment.
So I believe that in Europe we were to start about on aluminum forging side. So where we are at this moment?
Okay, we have had our first orders in the aluminum forgings, and we continue developing the technology plus the products, and we are working on it. I mean, there is no additional information that I can disclose, but we continue working on it.
Okay. On India business, any addition of new clients or any addition of the new business in Q3 vis-a-vis earlier quarter, and how those new customers which have been added over last 12 months is performing?
Any new big order? No, but all, in terms of new capacity additions, I think capacity additions are ongoing in almost every vertical there. As we have reiterated in the past, you have magnetics where there is an expansion program which will substantially increase capacity. You have a new plant at Gears, a new plant is being set up at AEL. All these are ongoing programs. You have CIE Hosur, where most of the infrastructure has been set up, and first order, we have started to generate revenue from that place, and it is now in the process of being ramped up. You had the warm forging plant which has been partially set up at Chakan. We will put in more machines there. So this is the capacity addition is an ongoing process. In terms of order book, if there are any significant new orders, at this time we don't have that. Maybe we will talk about it in the year-end call, but we'll let you know about the order book or the new orders generated in this year during that period.
So Vikas, my question was related to more on the new client acquisition or increasing the content per vehicle from the existing clients. So if you can give little more color on that side also.
No, in terms of increasing our share or having more business from our existing clients, that's going on. Whether it is Mahindra, as you know, Mahindra is going through a lot of new model launches. So we are there in all of the new model launches, as also the model launches next year in the EV space. Same case as far as Maruti is concerned. And also, we have a very strong situation developing in Tata Motors also. So that is in the four-wheeler segment. In the two-wheeler segments, we have talked about how CIE Hosur, we have had new orders. CIE Hosur has been set up for new orders that we have got, I think from PSA and Royal Enfield. So that is there. So we have, and like for example, Ender talked about how he's bullish about the tractor segment, which will have an impact on our plants at Rajkot and Zahirabad. We are receiving, from the new model launches by Mahindra in the tractor segment. A lot of them are slated in the coming few years, not necessarily in the next few quarters. But they have a strong, pipeline of that there, and we will be present in all of them. So to that extent, we are quite comfortable in this area.
Thank you, Vikas, and Ender, all the best.
Thank you. Thanks, Bharat. Thank you.
Thanks. Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. We have our next question from the line of Enrique from Best Inverse Securities. Please go ahead.
Good afternoon, everybody, and thank you for the presentation. I have several questions. The first one is regarding the bottlenecks, the bottleneck constraints that you have in India. Do you foresee the need to accelerate the capex allocation in India next year, or with the ramp up of the current investment, it will be enough to supply the market? Thank you.
Okay. It's true that we we have in certain businesses, in certain verticals, we are limited and we cannot continue growing if we don't invest. But our investment plan is solid and is done from, let's say, several years ago. Okay, even in the COVID year 2020, in last year 2021, and this year, we are investing heavily to, let's say, prepare ourselves to cope with the demand that we foresee from the market. Okay, so this year we are investing, and this I can give you the figure at close to till now 4 billion rupees on capex. Most of it is located in India, and we are adding capacity and we are adding plants in almost all the verticals. Okay, so we continue our capacity expansion trend, and because we needed to continue growing in the market. So we expect that during this year we will have an important capex in India. Next year we will have again, because we think that the Indian market will continue growing. And also regarding the mix of customers that we have, we see that okay, we are growing a lot with Mahindra as it is normal. I think Mahindra is doing really well, and with their products, with the new products they are launching, they are having a big success, and I think that will be a good opportunity for us to continue growing. Also with Tata, also with Maruti, I think that we are well located to continue our growth strategy. Okay, so to your question, yes, we have had limitations, but we are now launching additional capex aligned with our customers to fulfill with the demand. Okay, so our strategy is to continue our customers as much as we can.
Thank you very much. And the other two questions are regarding profitability in Europe. First one should be Q4. You mentioned that there has been some delays in the pass-through of energy inflation to some clients. So my question is, taking into consideration this pending pass-through and the limited visibility that we have on market demand, should we expect a sequential profitability improvement in Q4, taking into account this pending pass-through in Europe?
Okay, if the situation of the energy market is stabilized and the demand continues as it is now, yes, we should have this recovery. Okay, because we will be able to recuperate what we lost in the previous quarter. The point is that we don't know what will happen with the market in the next quarter, and we don't know what will happen with the energy. Okay, so that's why I cannot say a total yes or a very solid yes to your question, because it will depend on how the energy market plus the demand behaves. But in normality, yes. If you recall from the previous quarters, in the Q1 we were negatively affected because of the start of the war in Ukraine, and in February, March, the energy went up and we had difficulties, so we lost certain margins. In the Q2 we recuperate. Now in the Q3, as the energy is picking up again, we go down again. So that's the scenario we are suffering. Very, very complex scenario, and it's a really, really tough situation to manage with this uncertainty. But yes, I agree that in a normality we should be able to recuperate part of the margins that we have lost in this quarter.
Thank you. Very, very clear. And the last question is, if we talk about Q4, Next year, obviously, is going to be the year in which the huge labor inflation in Europe will have to pass through to clients. How confident are you of being able to pass through the labor inflation in Europe, which will be the first time in decades we're having to pass through this huge extra cost?
It's very, very difficult question, because my feeling is that during the negotiations that we have had in this period with the customers, they refuse to apply any price increase due to the inflation. Okay, they consider that they should pay the raw materials, because this is commodity is coming, and they pay the energy price. At the beginning they refused, but finally they agreed, and this is generally agreed by all the OEMs, because there is otherwise they will destroy the supply chain. So this is clear. But the inflation, that is the complex thing to pass through, because they consider that we should offset this with the efficiency gains and productivity gains internally. So if you want to know, my request to all the teams in my businesses in Europe, what we have done is we have set an internal target to offset this inflation in labor, and we should be able to offset that impact through the growth in the business that are growing, or through let's say social plans, or let's say firing people in order to increase our efficiency to be able to keep the margins. Okay, so that's the strategy. There is no way than resisting and improving internally to offset those impacts on the inflation.
Okay. Thank you very much.
Thank you. Yeah, thanks, Enrique.
Thank you. We have our next question from the line of Nikhil Kare from Axis Capital. Please go ahead.
Yeah, thanks for taking my question again. So just wanted to understand, so again, going back to the Europe performance, have we seen any benefit because, say, some suppliers are based out of Ukraine or Russia have been impacted? So are we kind of gaining market share because of this kind of an impact? Any examples of this?
No, not from Russia or from Ukraine. No, we have not seen this impact, or we have not been benefited from production coming from Russia or Ukraine. No, it's not the case. What we have been benefited in some small businesses is from some small companies that has been are close to bankruptcy because of the special situation in the European market. Mm-hmm. So there is a consolidation there. So yes, we expect to see certain consolidation in the market because of the bankruptcy, but from European suppliers, not the Russians or Ukrainian suppliers.
Okay, got it. And just on the capex side, you I think mentioned that you're seeing really good demand in India, especially when you're looking at capex. So what is the capex guidance for this year? We would meet say close to, would the capex be close to 5.5 billion rupees for the full year on a consolidated basis?
Yeah, in the capex in global, I think would be about 5% of our total turnover. 5%. That's the figure that we manage. Yes.
Yeah, that should continue going ahead for the next year as well, right? That would be a safe assumption.
That's right. Yeah.
Okay, got it. Thank you.
Thank you.
Thank you. Reminder to participants to press star and 1 to ask a question. We have our next question from the line of Siddharth Dand from Goodwill. Please go ahead.
Yeah. Could you give me the German PBT number of a German operations for 3 months, for the quarter and 9 months of Mahindra Forging?
Germany Forgings.
PBT in Germany.
Wait a moment.
No, I think we don't have it readily available, right? We will share this PBT numbers about the German business, at the year end. But what we can tell you in terms of gross margin performance, it is more or less similar to what we have done in the earlier quarter in Q2.
Okay, but is it at the PBT level? Is it positive or negative?
Positive. No, it is not negative. It will be around the zero mark. Even last year on a full year basis, it was something around that only. About PBT 0.5%. So it will be something like that only.
Okay. And my second question is about the debt figure. So what would be the approx debt figure now, and is it in India and Europe? And will interest rate have an impact over there?
Okay, so if you're asking about net financial debt, we are about 7.5 billion.
Okay.
And yes, it will have an impact because margins, the rates have gone up both in Europe and India, about 2%.
Okay.
But I think overall, if you see in our scheme of things, finance cost is not really significant.
Okay, so 7.5 billion, that is around 750 crore rupees, right?
Yes.
And what's the split in India, Europe about the debt?
India would be about 1 billion.
India would be about 1 billion. So mostly it is Europe debt.
Yeah.
Okay.
So if you want gross numbers, it is actually if you're looking for interest cost impact, you can look at NFD because we earn also, so that's okay. Yeah.
Okay. And my next question is, what is the India top line target by CY25, and can the margins reach like 17-18% like our parent margin for the India business?
So MCIE India C25.
Yeah. Yes, we have always had internally the target to have the same margins in India than in the rest of CIE. Okay, so that is clear. Okay, we don't disclose long-term target in our company, but as a strategy or at least our wish in MCIE, yes, we would like to be there or above. Okay, so what we see clearly is that the growth in India will be higher than the rest of CIE markets, and the margins should slowly but steadily should be able to recuperate and to grow to reach or let's say surpass CIE margins. Yes.
And growth, and what are the growth targets for the India business? Around 15%?
No, we don't have we don't have any such target that we have set for ourselves. What we normally say, normally work towards is whatever is the weighted average market growth, we will grow maybe higher by 10% than that. Earlier we used to say 5 to 10%. Now it will be closer to 10%. Will be higher than the weighted average market segment. When I say weighted average market segment, we have a certain portfolio spread in India across 4-wheelers, 2-wheelers, tractors and trucks. So based on that weighted average, we want to beat the market by 10 percentage points as a general rule.
Okay. Yeah. And about the interest cost has gone up for us, and so what was the cash pooling deal that we had with CIE? Is the interest cost still 1.5 over there?
No, it is always in line with this.
For the time being. Okay. Okay, I'll come back if I have any other questions. Thank you.
Thank you. We have our next question from the line of Ankur from Quasar Capital. Please go ahead.
Yeah, hi, thanks. Sir, I had a question on growth. So considering the interest rate hikes worldwide and the headwinds which the auto industry is going to face or is facing, sir, how do we think about growth? Because obviously our underlying business is linked to the automotive industry. So can you share some thoughts on, how we will grow, whether it will be purely organic, inorganic, because organic growth, it seems to be difficult to come by.
No, Ankur. As far as organic growth is concerned, we don't think that, at least in India, that would be the case, that we would not grow. Ander also mentioned that we have a lot of medium to long-term expectations from the Indian market, not just in MCIE, but also our parent CIE has that kind of expectations. So we do expect the Indian automobile market to grow. Of course, in the there are certain headwinds that we know around inflation and around the geopolitical scenario, and expectation of recession in many places of in many countries. But nevertheless, we do believe that the Indian automobile markets in all segments will keep growing. Why we say that? For example, the penetration ratios both in two-wheelers, tractors, and four-wheelers is much lesser compared to the global average. In the case of four-wheelers, it is only 28 per thousand, which is much lower than even other emerging countries. In tractors, also believe that the tractorization levels, there is a lot of scope for improvement in terms of horsepower per hectare. Two-wheelers, maybe only 50% of the households in India have two-wheelers, and two-wheelers is a necessity. So there is enough scope for growth. We also think that yes, there will be headwinds, but income levels will keep growing. It could be at a reduced rate compared to what could have been if there was no such headwinds, but nevertheless it will increase, and therefore this combination of demand as well as income, we do think that the medium to long term in the Indian automobile market will be good. To answer your question around Europe, I think Ander did mention that the European market has come down to very low levels. What used to be in the range of 20 million light vehicles per annum, today, this year is probably in the range of 15.2, 15.3 million. It was 15.5 million in the year before. It was around 16 million the year before that in 2020. So it is already at a very low level compared to what it used to be, and therefore there will be some recovery at some stage, even in the European market, because the base levels are very low. So we are not ruling out organic growth at all. We are quite hopeful as far as the organic growth is concerned. As far as your inorganic question, we have said that we will normally not want to do inorganic. We will not want to do any acquisition for the sake of growth. We want to do acquisition to fill up capability gaps in our portfolio. Whether it be, say, for example, any new technology or any new customer, that we would like, or any new segment that we could service. It would be largely for that and not necessarily to push growth that we would be doing an acquisition. So inorganic, we keep looking at it, and whenever we find something that really fits our bill, we will certainly go for it. But I don't think we are relying on inorganic strategy for growth. We do believe organic will be there, from a market perspective and overall. And as we explained in the question that Siddhant had asked, and especially in India, we do think that given our order book scenario, given the fact that we have been able to improve our efficiencies and competitiveness in the recent past, we will be able to grow faster than the market. We talked about a 5 to 10% or closer to 10% kind of figure higher than the India market growth. So not only we expect the market to grow, we also expect to grow faster than the market in India. So that is our thinking at this point of time. Yeah. Okay.
And sir, one more thing, like I heard about an interesting strategy which MCI is following, that localized manufacturing and production. Like the context is that I was just thinking from a company operational perspective, and the way inflation, the energy prices, and all of it, it is hitting the manufacturing operations for each and every company. So considering that, aren't the customers, like the end OEMs, looking forward to a low-cost manufacturing base rather than just a localized base? Yes, maybe temporarily till the time there are, logistical issues or any of those sort of issues, it is understandable. But let's say in the medium term to long term, won't these OEMs, big OEMs, think about rationalizing their cost structures and shifting, their supply chain, maybe a more diversified supply chain, but to a lower cost supply chain like the base which we have in India? So, can you share some thoughts on that?
When we say, it is CIE's stated strategy as far as local for local is concerned. By and large, it would continue like that. Yes, you are right. There will obviously be a quest to look for lower cost sources of manufacturing, and this has to be balanced with all the logistical risks that companies have faced in the recent past, whether it was due to COVID or due to the the semiconductor issues that people were facing, or even to the shipping cost situation that happened last year. There was a container shortage that was so. All these things have to be balanced together. So there is a need for low-cost manufacturing, and then there is a need for these balancing of supply chain. So when it is said that local for local, it does not mean local means Maharashtra for Maharashtra, or something, or just only India for India. By and large, that would be the case. But wherever, as low-cost markets, wherever we have opportunities to export, we will export. So that is, it is not as if we will not, or whether this China plus one strategy, are we benefiting? Yes, in areas like gears, in areas like magnetics, we gain from this kind of situation. So both the things are correct. So what you are saying is also right. Wherever we see an opportunity, we'll take care of it. But by and large, OEMs now try to balance their supply chain risk, and that is the reason why CIE has that strategy. Yeah.
Okay. So can you just quantify the amount of exports from India, like a percentage of sales from India in terms of exports?
Roughly about 12 to 13%, and we have said in the past that we would like to increase this. About 2 years back, I think if you go back to our transcripts, we had mentioned that we want to take it up to 20%. But after that, there has been a very strong domestic demand. You heard how we have, we are increasing capacity in each of our verticals. A lot of it, and a large part of it, is to service the demand from our customers in India. So to that extent, our first priority is definitely to service our existing customers. So yes, we do have at the back of our mind, but at this point of time, our first priority is to fulfill the demands of our existing, of our order book, essentially, that we already have.
Okay. And just one more point. It is just coming from a perspective that, there is one of the portfolio company, like, let's say, ZF Commercial Steering, okay? So let's say this particular company, it is manufacturing certain parts in India, okay? And it is supplying to some of the supply chains worldwide. So from a CIE perspective, is CIE looking at their supply chains from synergy point of view that, let's say there is a particular part which they are able to source it well from India in a better way, or let's say they are able to source it better from Italy unit in a better way. So are we, I just wanted to know that are we using the global platform base and the global manufacturing platform base to actually benefit from this, benefit in terms of many things like cost and other things. So are we open to do that? Because this local to local, it seems like, especially if I think from a medium to long term perspective, it seems pretty tough
Okay, the local-to-local strategy is a general strategy, okay? It doesn't mean that 100% of the production will be local-to-local. There will be a percentage that for sure, for cost reasons, for synergies, even for technological reasons, could make sense that we could concentrate in the production of one component in one region and then export from there, okay? So, and in that sense, India, of course, is well located because the cost base is much more competitive than the rest of the regions. So, yes, we can see what you propose or you mention, depending on each product. As a general rule, we prefer to go local to local, and but in certain cases, of course, we will produce in India and we will export. Okay, and especially, for example, in certain technologies that are only available in CIE in India, we will produce for sure in India and deliver to the rest of the countries. Okay, so let's say that we have a very open mindset on this. We set our general strategies, and what is true is that Vikas explained before, saying that we were planning 2-3 years ago that our export rate should grow importantly and pass from this 12% to 20, even 25%. In this moment, we think that this is not the right strategy because the local market is demanding more than enough in India, so we are struggling to supply to the current customers here in India, so that is the good thing. And secondly, there is the logistic cost is now has gone up dramatically. Also, not only the cost, because the availability, in certain moments we were not able to find ships to deliver our products. And also there is a big pressure especially in the European and American customers to reduce the CO2, the carbon footprint. So let's say, considering all these things, I think we will focus our efforts on locating the production in each of the regions. And of course, if there is an opportunity and if there is a need, and there is a certain product that makes sense to produce and export, we will do it for sure.
Okay. And sir, last question, just the last question. Sir, I was just going through the annual report, and there was this very interesting data point which I found that currently the incremental vehicles sold are more of a hybrid vehicle than a pure battery operated electric vehicle. Okay. So, can you just, share your viewpoint on the trends and the way your customers are perceiving their strategies? Like, are they pursuing their strategies from a very open perspective and they are letting the market discover, or they are particularly saying that hybrid vehicles is going to take the lead? Can you just throw some points, because this is important, because it is also written in the annual report that if it is a hybrid vehicle, the content per vehicle for Mahindra CIE increases.
You're talking about Europe, I guess.
Yeah, Europe. Yeah, correct. Europe.
Yeah. So Europe, that trend remains the same. Battery electric vehicles, even in this quarter or YTD this year, up till September, are about 10%. And hybrids are around 20%. Overall, between petrol and diesel, they are close to 55 odd percentage. Now it is whether it is deliberate strategy or that is the way the market is evolving. So at this stage, it is very hard to say whether it is because the OEMs are pushing or the market is evolving. What we think, based on last year's, aggressive plan that the European Union had announced on that 55% reduction in emission, we do think that by 2030, about half of all the vehicles sold in Europe would be pure battery electric vehicles, but that's 2030. So that's the expectation based on whatever, like for example, IHS is telling us on, based on this new revised, the new revised guidelines that the European Union has issued. Earlier, of course, this number was 30%, pure battery electric vehicles by 2030. It has gone up to 50%. How between now and then, how this mix changes, etc., we'll have to see whether it will be hybrid or only pure battery electric vehicles. It's based on many things. There is charging infrastructure, there is the way people drive, long distance, short distance, the inflation considerations, the subsidies that the government give. So there are a lot of variables. So exactly between BEVs and hybrids, how is it going to be? We really don't know. But to your point, in the medium term, do we perceive that it could be advantageous for MCIE? The answer is yes. Not just from a hybrid point of view, but also from the traditional powertrain. The traditional powertrain is still a large part. As I said, almost 50%. Even if it comes down to 30% of, say, a 16 million, 18 million market is a huge number. So there, not much investment is going into the conventional or the traditional powertrain component manufacturing. So to that extent, opportunity lies there also. So in the medium term, actually there is a lot of opportunity, not just risk, to look forward to in this transition. But to answer your original question, it is very hard to say whether the OEMs are pushing this or it is evolving. I guess I'll request Ander also to add his views onto this.
No, I agree, because I think the hybrid vehicles are the best solution for Mahindra CIE, because the amount of components is higher. So we have both electric components plus the internal combustion engine components. But I see the hybrid solution as a temporary solution. Okay, so it's the bridge. The hybrid will give the bridge to the electric vehicle, to the pure electric vehicle in the future. So I think it's a necessary step. It will be used and it will be probably massive in the next 4 or 5 years. And then once all the charging infrastructure is already set, then there will be the transition to the smooth transition to the pure electric vehicles. Okay, so that's my view. So I think there will be growth on the hybrids, and then the growth up from, let's say, 2030, 2032, then we will see a pure battery electric growth importantly.
Sure. Sir, thanks a lot, everyone. All the best.
Yes, thank you.
Thank you.
Thank you. I would now like to hand the conference over to the management team for closing comments. Over to you, sir.
Yeah, thank you. Thanks for your time. I'll request Ander for the closing remarks.
Yeah, so thank you to all the participants for the well-directed and clever questions that you did. I hope that we answered properly and you have now the better knowledge of our company. As always, I would like to say thank you to all Mahindra CIE team that has been working in a very hard and difficult conditions during all these months, and I thank you for their effort, their commitment, and their work. Okay, and finally, I just wanted to say to have nice and happy Diwali festivals and enjoy with your families and rest, because I think we will have after the festive season we will have to fight again in this complex market. Thank you very much.
Thank you, sir. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.